Hey folks, welcome back to our Forex Trading episode 8. And today I want us to basically do a recap of what we have already covered this far. And also I will introduce the topic of technical indicators. And at the end of this lesson, you'll be able to understand the various types of technical indicators used in Forex trading. With a recap of what you have previously covered, so far so good, we have covered a huge chunk of Forex trading. We have covered the definition of Forex trading and also what is Forex. And we said that Forex is an acronym of foreign exchange, and Forex trading is the buying and selling of currency pairs online. We also talked of Forex market participants, whereby we saw that we have the big banks, we also have the governments and corporates. Then we have the fund managers, and also besides the fund managers, we also have other companies. Also, we have retail traders. So we have four categories. The first tier, big banks or commercial banks. Then that second tier, we have governments and corporates. That tier, we have companies and also fund managers. And in the fourth tier, we have retail traders. That is me and you. We also looked at various currencies, and we saw that they are basically most common traded currencies. We had the New Zealand dollar, we have the USD, we have the AUD, that is the Australian dollar. We have the euro, we have the JPY, that is the Japanese yen. We have GBP, that is the Great British Pound. Okay. Then we also said that currencies are traded in pairs. Therefore, we can have a pair like GBP USD, GBP JPY, Euro USD. You cannot trade a single currency because there has to be an exchange from one currency to another. We also talked of the various classification of pairs. And under classification of pairs, we said that pairs are classified into three major groups, or three groups. We have the major currency pairs, and these are currency paired with USD. For instance, we have GBP USD, Euro USD, USD JPY. Therefore, as long as a currency is paired with USD, that currency pair is called a major. USD is basically the most traded currency because if you look around, this currency is accepted globally, and most nations or most transactions, when you're doing most transaction online, you pay in terms of USD. Therefore, it becomes the most traded currency, and the reason why any currency pair or any currency that is paired with USD becomes a major. Then we have minor currency pairs, and these are currency pairs derived from process of GBP, Euro, and JPY. Basically, these currency pairs are not connected or are not paired with USD. For instance, we have Euro JPY, we can have GBP JPY, we can have NZD JPY, etc., etc. As long as it is not paired with USD, it becomes a minor currency pair. Then we have exotic currency pairs, and exotic currency pairs, these are currency that are paired with these are currencies that are paired with a currency from an emerging economy, okay? For instance, we have South Africa, which is an emerging economy, and their currency is called South African Rand. Therefore, when you have a currency pair like USD ZAR, this is an exotic currency pair, even if it has USD, but as long as it is connected with a currency from an emerging economy, it becomes an exotic currency pair. Other emerging economies are like Sweden, whereby we have the Sweden krone. We also have the Norwegian krone, that is from Norway. Okay, so any currency that is paired with a currency from an emerging economy, it falls under the category of exotic currency pairs. And exotic currency pairs, these are not highly traded because their cost of trading is very, very high. That is, their spreads are very high because they are not basically traded in large volumes. We also talked of how to read a currency pair, and we saw that currency pair, when you are given a currency pair, the first three letters on the left represent are called the base currency, and the three letters on the left, on the right, are called the quote currency. When I'm talking of the three letters, we said that a currency has three letters. The first two letters represent the country, and the last letter or the third letter represent the currency of that country. So when I say the last three letters, I mean that the currency on the left, for instance, the currency on the right is called the base currency, and the currency on the left is called the quote currency. For instance, if we have GBP USD, GBP is the base currency, USD is the quote currency. We also discussed or learned about how to calculate pips. And just a recap, we said that currency pairs with 5 decimal places, we start counting pip from the 4th decimal place. We also said that currency pairs with 3 decimal places, like currencies that are paired with JPY, we start counting pip from the 2nd decimal place. For this, on how to calculate pips, at times it becomes challenging for one to understand, and therefore I recommend that you go back and listen to the video that I taught about how to calculate pips. And therefore, after you learn about or after you refresh, you need to do a lot of practice so that this can be in your fingertips. Because if you don't know how to calculate pips, it means that it will challenge you, especially when you're trying to set your take profits, when you're trying to set your stop losses. It will become a challenge for you. And also, the knowledge of calculating pips is conjoined with the knowledge of determining how much you'll be able to make in a trade. Okay, therefore, it is a very critical concept that you cannot afford to miss, or you cannot afford not to understand it. Then we discussed various trading strategies that we have covered this far. We talked of SNR, that is support and resistance. And in support and resistance, we said that you look to buy at support and you look to sell on resistance. When I say you look to sell or you look to buy, I'm saying that it is not a must, because the market can decide to break the support. It can also decide to break the resistance. Okay. Therefore, when I say you look, this means, or it brings the concept of probability, and you need to look for signs, or you need to look for confirmation of buying or selling at these points that I'm talking about. Okay, we discussed that in the video, and maybe you can go back and refresh. Then we discussed the trend lines, and we saw that there are various types of trend line. We have the uptrend and we have the downtrend. Okay, so with the uptrend, we said that in an uptrend trend line, you look to buy when the market touches the trend line and confirms to you that it is actually going to bounce back from that area of the uptrend trend line. With the downtrend trend line, we said that there you look for your sells. Okay, you look for your high probability sell entries. We also we discussed about channels, and we said there are 3 types of channels. We have the up channel, we have the down channel, and we have the sideways channel. Okay, so in an uptrend channel, this is whereby you look for your buy entries. In a downtrend channel, this is whereby you look for your sell entries. In a sideways market, you can either look for buys or sells depending on various factors of the market, or depending maybe factors like maybe what was the previous trend? Was it a downtrend or was it an uptrend before the market consolidated? And I said that for you to be able to make or to take high probability entries, we will be covering that part when we start looking at various chart patterns, okay? But for now, it's best to try as much as possible to trade a sideway market or consolidation, because it can get you in the wrong side, or the market can break in the opposite direction of your trade position. Okay, so with the channels, trend lines, and support and resistance, how you identify your confirmation is by using various types of either candlesticks patterns, or once you see the price bouncing off from these areas, depending on which type of, for instance, which type of trend line or which type of channel, and also depending whether it's support or resistant. Therefore, the candlesticks patterns that we just completed, it's a very key concept that you cannot afford to miss. You cannot afford not to understand it in trading Forex, because these candlesticks patterns that I taught, they are high probability candlesticks patterns, meaning that when you understand how to trade them, when you understand how to apply them in your trading in terms of maybe exit, entries, continuation, and and also confirming reversals, it will help you so much big time when you're trying to take your entries in areas of support and resistance, in when using trend lines, and also when using channels. Remember, the key thing with Forex trading, before you take an entry, it is always recommended that you have at least two reasons why you took that trade. Whether you took a buy, you need to explain with at least two reasons why you took a buy. Maybe it was at the area of support, maybe, and also secondly, maybe you saw a reversal candlesticks patterns such as bullish engulfing, okay, such as bullish engulfing, or also such as dragonfly dojis or pin bars. Okay, so you need to have at least two reasons why you took a trade, either for a buy or for a sell. These will indicate that your trade is a high probability trade. If you cannot have at least two reasons why you are taking a trade for a buy or for a sell, then that might not be a high probability trade. And the reason why I encourage that it is not best for you to take that trade. Okay, so basically this is a summary of what you have learned so far. I would encourage you to go back, refresh, study all in the areas that you feel that you did not understand well, and ensure that you try to have a mastery of this concept, because this lays the foundation of the basic knowledge when it comes to Forex trading. Then in our next lesson, we are going to dwell more on technical indicators. But in this video, I'll just introduce technical indicators. And technical indicator is a mathematical tool that is used to analyze volume and price data. So traders use technical indicators to help them identify probable trade entries, and therefore they are able to make trading decisions. There are various types of technical indicators. We have the moving average, we have the RSI, that is relative strength index, we have the stochastic, we have the moving average convergence divergency, that is MACD, we have the Bollinger Bands, and we have the parabolic SAL, that is top and reverse. Just like with the case of the candlesticks patterns, there are various types of technical indicators, but these that I have chosen, they are technical indicators that are easy to use and that will give you a high probability confirmations, okay? The only issue with indicators, according to me, I usually say that indicators are lagging span, meaning that they follow the price. Okay, so the reason why I'm not a trader who uses technical indicators, I am not an indicator trader person, and this might become one of the boring lessons for me to teach, because I basically don't use indicators, but it is best for you to use indicators, because I have seen traders who use indicators and they do well or they perform very well. They are profitable traders in the Forex trading market. Therefore, I cannot assume it. I cannot assume them. And the reason why I need to teach you, because you need to understand how to apply them. Probably this might be the best for you, and it might be the best strategy for you in Forex trading. Otherwise, on my case, I am a plain chart trader. I don't use indicators. But as I said, I'll take you through each and every indicator that I have listed here. And as a beginner, it's up to you to test them all and see which is the best for you. Okay. Even with the candlesticks patterns and the strategies that we have already covered, it is advisable that a beginner you try test them all while you are journaling your trades and see which best suits you or which gives you a high percentage or a high margin of profit. And then you specialize on that one. The one that is the best for you, you specialize on that. That being said, I think we will continue there from our next lesson, whereby we shall start looking at each and every technical indicator, how to apply it in terms of entries, how to apply it in terms of exits, and also how to apply it probably in terms of continuation, depending on which type of technical indicators. So thank you so much, and see you in the next lesson. Remember to subscribe, like, and comment, and also share this link with others so that they can be able to benefit as well. Thank you so much.